Hi, I'm Erik from the Hedge Invest Africa Opportunities Fund. I want to give an update on December and the year 2018. During the month, the fund was down 2%, which was a bit worse than the index, which was down 1.8%. For the year, it was down 7.8% versus 13.7% index and 17% the South African JSE All Share. So as you see, we outperformed the index by 600 basis points during the year. Even though we outperformed the index, we're not happy about the fund's performance in the second half of the year. In hindsight, we should have been more defensive, but I think the reason we missed that was fundamentals in Africa haven't changed much in the last 6 months. What has changed has been there's been a lot of selling from foreign investors. As we go into 2019, valuations of many of our stocks are at 10-year lows. Sentiment is awful, and there's been capitulation selling in Kenya, Egypt, Nigeria, and South Africa. To take advantage of this, during the month, we increased our equity exposure from 26% to 47%. We bought shares in some of our favorite stocks, such as Safaricom, and in the financials, we bought Nigerian banks, GT and Zenith Bank. We bought Kenyan banks, Equity Bank, KCB, and in South Africa, we added to the Johannesburg Stock Exchange. We also added to stocks in mining and energy, as we believe the commodity cycle is going to continue again in 2019. And meanwhile, these companies are generating significant cash flows and buying back shares. In the bond portfolio, we bought shares we bought Ghanaian bonds yielding 20%, and we bought 7-year South African bonds yielding 9%, which might not sound that great, but if you consider South Africa is still investment grade and will have inflation below 5% in 2019, it's a good real yield. Finally, in the short portfolio, some of our shorts hit our price targets, and we covered them and reduced our shorts. So overall, I think the end of 2019 was a surprise for everyone. It was a negative return for markets around the world. It was a surprise to fund managers, and they ended the year bearish and defensively positioned. We're trying to do the opposite of that. We're trying to take advantage of extreme skepticism, negative returns, and super low valuations. And we're increasing our equity exposure and our bond exposure and really trying to catch the upside in 2019, which I think could be a surprisingly positive year. Thank you very much.